Okay, let's go ahead and go through the solution to question 3 from the Module 2 homework assignment. This is an example of a change from the cost method to the equity method. So on January 1st, 2018, we started acquiring Little Company stock. Little Company has 1 million shares of stock outstanding. On January 1st, 2018, we buy 50,000 shares or 5%. January 1st, 19, we buy 100,000 shares or 10%. January 1st, 2020, another 100,000 shares or another 10%. So at that point, we're up to 25% ownership, and we're going to switch from the cost method to the equity method. And provided there is some information regarding income and dividends for Little for 2018, 2019, and 2020. So first, in 2018, under the cost method, we go ahead and purchase our shares of Little Company for $200,000. Little Company pays $100,000 in dividends. We own 5% of their stock, so we get $5,000, and that's going to be investment income or dividend income. Similarly, in 2019, we spend another $410,000 to buy another 100,000 shares of stock. We now own 15% of Little Company stock. Little Company pays $150,000 in dividends, of which we receive 15% or $22,500. Okay, in 2020 we make our third and final purchase, 100,000 shares for $425,000. So we record that purchase in the usual fashion, and now our ownership is up to 25%, and we have to record the change to the equity method. Now, as we know, a change in accounting principle is handled retrospectively or retroactively, where we want to make our balance sheet appear as though we've always used the new method. So first, let's go ahead and think about the income that we have reported versus what we would have reported. Under the cost method, we reported investment income of $27,500 over the previous 2 years. If we had been using the equity method, in 2018 we would have reported investment income of 5% of $200,000, in 2019 15% of $300,000 for a total of $55,000. So if we'd been using the equity method, we would have had $27,500 of additional income over the previous 2 years. Having that additional income would cause us to have additional retained earnings. On the debit side, the investment account under the cost method is simply limited to the cost of our investment, in this case $1,035,000. Under the equity method, as we reported the $55,000 of investment income, we would have increased the investment in Little account. As we received the $27,500 in dividends, we would have reduced the investment in Little account. So if we had been using the equity method, the investment in Little account would have been $27,500 higher. Once we make this change to the equity method, now we're going to go ahead and account for our investment under the equity method. We now own 25% of their stock. In 2020, they report $400,000 in income, our share $100,000. Similarly, they pay $200,000 in dividends, our share 25% or $50,000.